we are actually going to start talking a little bit more about strategies and how to invest in the crypto space. You've probably heard us before talking about, we kind of think now is the time to really start deploying your money, making positions. So we thought we'd give you some insights into how we think about the market, how we actually do our strategies into the market, to try and help you guys along the way and understand how we go about doing it. It may not work for you, but some good insights to help give you like another tool in the box for you guys to also start making investments in this space. So, of course, joining me as always is Will. How are you today, mate?
Hey Simon, doing really good. And just to echo what you're saying, knowledge is power. And a lot of people usually get into these investments in crypto, usually at the wrong time and usually not exactly for the right reasons. A lot of the times they hear about an app or a new token, it might be Pepe or something like that. And let's be honest, you can make money and they do make money from all of these things. But then the whole idea is that in order to consistently win in this game, it's really important to have a strategy, super important to go beyond what we hear in the news and really have like a really good foundation that can take us through this crypto journey so that we enjoy ourselves, we don't get stressed too much, but at the same time, we take it seriously and we end up holding good tokens and profiting.
Absolutely, mate. So, definitely, I think this is going to be super helpful for people to understand kind of some do's and don'ts in a way, but also to just get yourself into the right headspace to do it. Why don't you start us off here? We are talking about starting with a mindset. So, what do you mean by that when we're getting to investing in crypto? Why do we start there?
This is one of the most important things, I think, because without the mindset, it's really hard to do anything else. And I personally like to look at crypto as a Vulcan would. Shout out to the Star Trek fans out there. But then the Vulcans are really good at controlling their emotions, and you hardly ever see them celebrate or become really sad. I mean, they are affected, but not overly affected by situations. And in terms of investment, this is in crypto and I think any other area, I think stoicism is super important. It's really important not to get carried away by the crowd, and really important to accept your losses in the same sort of stoicism that you accept your wins. And I believe that by starting out with the right mindset and emotional sort of integrity, and this is something that we're not experts in, but it's something that we actually do try to practice consistently. So whenever I get a big win in crypto, yeah, I'll feel like doing backflips and I might do one or two, but I'm not going to go crazy. I'm not going to let it get into my head. And just by having that kind of discipline, the same thing happens when I do experience a loss. I don't chase the loss. I say, well, that happened. I might take a beer or two, but that'll be the limit of my celebration, of my peak, and that'll also be the limit of my low. And that mindset is a great foundation to be able to follow anything else. Without this mindset, what happens is users or people, myself, really tempted to chase the highs, throw in more money after good money. That could end up disastrously. And also throw bad money after bad money. That's also not the best thing to do. So that's how I think about emotions. What about you, Simon?
Well, first of all, I reckon you should film the next time you do this backflip when you get really good success in crypto because that'll make great content for us.
I'm rich! I'm wealthy!
I'd love to
Yahoo!
see that. But on a serious note, emotions are the hardest thing to control in this space. And I guarantee you, if you've made some significant gains, and in a bull market, we still have 30%, 40% pullbacks, when you see your portfolio go down like that, it is incredibly hard. And I don't think anyone can be fully prepared for that unless they've kind of gone through it. So be ready for it as best you can. But if you have made a significant investment and it's gone up a lot, and then you see that significant investment fall a lot, it is very hard. So just be prepared for this roller coaster. I think everyone has to go through it. But I guess what we talk about next, about strategies and things like that, will help you
Mm.
along that way. It's never going to be an easy ride. It's a very volatile market. So you can't avoid these emotional highs and lows. You need to accept them as they come along and, I guess, embrace them as best you can. But that comes with experience, it comes with time, and it comes with a strategy.
Mm. And I think everyone needs to go through that gauntlet. They need to get into the market. They need to get their hopes up, and they need do need to get burned. And it's really good, I think, coming in knowing I'm gonna get burned, I am gonna get burned, and just having that mindset ready so that when it does happen, you go, oh, there we go, it happened. Because let's face it, bulls and bear markets happen all the time, and none of us can hit at the right time. We never sell at the right time. It's impossible. You either sell too early or too late, and you definitely miss some gains. It's gonna happen. So yeah, to echo what you're saying, it's yeah, emotions are super important.
But I would also add, yes, you are likely to get burned at some point in time in crypto. That's common in any investing. So that's nothing just unique to crypto, but I guess that's portfolio management as well to make sure you minimize the losses by choosing the right risk to reward ratios. It's putting more money in the things that are more likely to go up, but obviously not
Mm,
earn as much reward. So portfolio strategy and a portfolio management or allocation is probably the right word is important. That'll help you with your emotions. So moving on to our next little topic there. So we're talking about having a strategy. So what's the reasons behind needing to have a strategy, Will?
Without really going too deep into specific strategies, and one of the ones you mentioned is super important, portfolio management and rebalancing and all of that, really key. But a strategy is actually connected to the emotions. And the whole point of this is that when we're creating a strategy, we're doing it at a point in time where we might be a little bit excited that we're going to start getting into crypto, but then the emotion hasn't taken us over yet. We're not in a crazy bull. We haven't got on top of the bull yet, and we're not riding yet. We're sitting on the sidelines and thinking to ourselves, this is how I'm going to ride this bull. It's going to get wild once I'm in the arena, but the best time to plan is when things are calm, you don't have anything in the market, and you have your rules. And the good thing with having these rules is that you try to create, first of all, strategies. You try to create contingencies. If this happens, is what I'm going to do. If I don't know what I'm going to do, I'm going to call this person. It's important to have all of these things really lined up, and including honestly with if everything goes to zero, this is what I'm going to do. I personally feel that I need to have that down somewhere on paper, knowing that if my crypto goes down to zero, this is what I'm going to do. Because I don't want to freak out when I'm in the arena. I want to have everything solid and ready before I get in. And it protects you from FOMO, and it gives you so much more confidence once you get in there and you're ready to ride the bull. And best of all, once you've got your strategy, over time you can make adjustments to it because this happens and then your strategy tells you to do this and then you get feedback from the environment and then this becomes your new thing, and you also talk to other people, you do get better strategies over time. But the key thing here is after you've got the right mindset, the next thing you need to figure out in a list of checkboxes is, do I have a good strategy? How do you see it, Simon?
Yeah, strategy is key. And I think I'll just you talked about rules there. And I think I'll just give people a few ideas of rules just so we're not just talking about things without giving some examples. So, some simple rules are if you're investing in a low cap coin, then you may want to sell it after it doubles or triples to get your initial back. It's often talked about quite a lot on crypto, and it's a really good idea if you are taking a small amount of your percentage of portfolio into a very high risk asset to make sure you get some money out.
Mhm.
But if it's a high conviction play, that may not be the best option for you. So you can create your own rule around that. Maybe it's actually 10x. Maybe it's actually, oh, I'm actually going to sell when it hits this price based off this market cap. Write your rule down before you actually buy the token, I think is kind of a key thing here of your exit strategy before you buy. I think that's a really good rule to follow. You might also have a certain percentage that you're going to put into the large cap coins. Like you may say, okay, like 70% of my portfolio is going to be in just Bitcoin, Ethereum, or maybe you've got a bit more risk tolerance. So you might say, okay, that's going to be in the top 10 coins. I don't know. You can come up with your own rules there, but they're important to have so that you refer to them because, yeah, when euphoria is kind of hitting, you don't make good decisions. And so it's great to have a
Mhm.
strategy. And yes, you can change your strategy around a little bit, tweak it a little bit as you see fit as it goes. But honestly, if you've set sell prices, just stick with it because obviously that is something you've thought about long and hard beforehand. So that kind of element is important. I think if you write these kind of strategies down, stick to them reasonably well. Don't just chop and change it as you see fit as you're going along because that's going to end in disaster for you. I feel if you keep pushing the boundaries.
Mm. And maybe if you're listening and you find this really interesting, just let us know if you want to go through specific strategies, because there's probably different ways you can, I suppose, go for the market depending on your risk tolerance, what you're after, how long you want to stay in the market. There's all sorts of interesting strategies, and they all have risks and benefits. It does come down to what you're after, and and how much time you're willing to put into it, and how much you want to risk and how much you want to gain. So all of these things come into play. But once you've got your strategy, you also have an amount of certainty, I suppose you could call it. Nothing's 100% certain, but at least you've got a direction that you know you're heading, and you've got an intention, and that's so critical in terms of trading.
Yeah, and I would say that what you said there is really important. Strategies come down to the individual, because often when I've talked about this before, people kind of think, oh, it's such a cop out. You're not really giving us a strategy there. You're kind of giving just some ideas. That's because, yeah, the strategy is very unique to the person, unique to how much money they've got to start with, how long their time horizon is, how much risk they're willing to take. So it's very hard for there to be a one size fits all strategy. I mean, at the end of this conversation, I think we've got a few kind of strategies and different things we're going to talk about to give you some further details on that. But yeah, it is individualized. So you can't just come and ask someone, tell me a strategy, because it doesn't really exist. You really do need to individualize it based off your own personal profile, your own personal risk tolerance, how much you're trying to make, those kind of things. So that's why if you're feeling like, oh, we're just copying out because we're not telling someone how to do it. Well, we're not here to tell you how to do it. We're here to give you our opinions and our ideas. Let's move on to the next part. So we're talking about here knowing the tides. What do you mean by knowing the tides, Will? How is that important?
This is my favorite one, and I think, in my opinion, probably the most important one when we're getting into crypto, in that this could almost be my entire strategy if I don't want to spend too much time in crypto, or if I'm super new and I'm just dipping my feet into it. I think this one is probably the biggest thing. And it took me a while to actually understand this about crypto, which is a little bit embarrassing to say, but true. But then the thing is, crypto is as almost as predictable as the tides, in that there's going to be a high tide and there's going to be a low tide. I can put my money on that. Now, what's a little bit difficult to say is when these tides happen. That's a little bit harder to say, but then these cycles do happen. And once you're in a cycle, it's really obvious. It starts to become super obvious. For example, when you're in a bear market, no one's interested in Bitcoin. The news is certain that Bitcoin is going to go to zero. Nobody cares about Bitcoin, and that's one of the surefire signs that you can tell, emotionally speaking. And there's of course you can look at moving averages and everything, but generally, once you're in a bear, you can usually tell you're in a bear. And once you're at the height of a bull, it's really pretty obvious when your barber starts telling you about Bitcoin or his favorite new token. That's a surefire sign for me to go like, oh my God, I think we're in a bull and I need to start working out my exits. So with this one thing in mind, uh, I think what we need to realize is that a rising tide floats all boats. And that means that if you can get in towards the bottom of a bear, you're almost guaranteed that whatever token you're in is probably going to go up with everything else once everything starts going up. There's no guarantee it's going to stay up there. But usually during the bull market, everything does go up. So the trick is to actually get in super early during the bear and just hold on for a while, and never get tempted to get in during a bull market. That's really dangerous. How about that, Simon?
Yeah, I agree with you entirely there. And I guess this is not unique to crypto. The ups and downs of markets is common in the stock market as well. It's less common in real estate, because real estate, I guess, tends to be a bit more stable because it's not as liquid. It's hard to sell and buy
Mm,
properties. So that
mm,
slows the volatility of that market down, but it still has cycles. Property prices still go up and slightly down and then up again, especially in Australia anyway. Different markets around the world, a bit different. But stock markets, very much so, ebb and flow based off huge macro events. Crypto is also affected by those macro events. So it's not unique to crypto. This is not a unique investment advice about crypto itself. This is just general investing advice, because there definitely are bull markets and bear markets and everything. So that's something to keep in mind. On to the next thing
mm.
here. Will, you've written down zig when others zag. I like that, but what are you meaning by
Yeah.
that?
This is really close related to the tides. The problem with the tides is that a lot of the crowd follows them. And this is really dangerous. And what you really want to do is do the opposite of what everybody is doing. And that is usually where the early money goes. And early money usually means lower risk and higher profits. The other thing is that whales are especially good at doing that. And another way of calling zigging when others are zagging really is to follow the whales. The whales pretty much do the opposite of what everybody else is doing. And banks have been caught doing this, and other institutions as well. It's fairly common for an institution to spread the word out, tell you get CNN to announce it somewhere. Oh, these are the news sources, Fortune magazine. It doesn't matter where the news comes in. Everybody reads these magazines thinking that they're looking at fundamentals, but really, what these big companies are doing is they're creating volume opposite to where they want to go. If they want to sell their tokens, for example, when Bitcoin is really hot, that's when you see all of these news companies and organizations reporting all of these things. And some of it is organic, but some of it is actually whales trying to offload their tokens to newbies. And it doesn't even have to be a massive whale. If you've got enough money to influence a magazine, you'll do it. And as long as you can get newbies to buy when you're selling, you've got all the volume you need to offload onto them. And this happens more often than people realize. Something else that you need to be careful for is when you're looking at technical analysis. You think you can look at a chart and say, "Oh, yeah, this is this kind of pattern. This is probably what's going to happen in the next three candles." Well, guess what? You're not the only person looking at that. There's bankers out there looking at this, knowing that, oh, this is what they're about to do, and the bankers have enough volume to actually push you out of your position. And once they sense there's enough people over there, they know there's stop losses covering them and everything. They have enough volume to push the price down. That triggers the stops and sells, and then they come up and pick really cheap tokens and go all the way up. So, I mean, it's a really dirty game when it gets down to it. But I think when you understand how zigging and zagging works, it's a good way to cover yourself and basically not get carried away with the news or the fundamentals. There's definitely other places you can get real fundamentals from, but it wouldn't be where everybody is looking. I think that's a real dangerous place to look for fundamentals.
Yeah, I think
What are your
to
thoughts?
put
Yeah.
to put this into, I think, a way that people can understand better is that I think if you're a retail investor, do you really think that you have an edge over people who spend their time full time in this market? I'm full time in this market, and I don't think I have an edge over most of these people. So I don't tend to try and play those games as much because it's incredibly hard to do that against people who are probably a lot smarter, who have a lot more funding, who have teams of people watching the space and manipulating the space per se. So thinking that you have an edge that nobody else has, thinking that you have the inside idea on something is maybe you might, but have a good hard look and think about that before you go taking that action because there's probably
Mm,
a lot of people out there who've already had that thought or process for you. So don't think you're the smartest person in the room. I guess would be my advice there.
mm. It's really humbling, but it's really good thing to keep in mind.
All right, so moving on to the next part here, we're talking about curating your sources for information here. So what are we talking about there, Will?
Well, this is another favorite of mine in that once we start to understand all of these rules and having a strategy, yes, we should practice and try to do these things ourselves, but even doing our own research and everything. But something that can save us heaps and heaps of time and brain power and effort and educate us actually is by finding other people who do this for a living and really love it. And there's a lot of these people out there. They're on Twitter, they're on Reddit, they're busy posting their analysis, they're on YouTube. Now, the only thing there is we've got to find the right source and curate it because there's a lot of shields out there as well. But there's industry experts out there, Vitalik Antonopoulos, I'm not sure exactly how to say his name, but there's industry experts out there. And it's really nice to follow these kinds of people and just have a nice list on Twitter that just purely follows them. And once they get excited, whenever I see Vitalik excited, I get excited because he's an expert that I follow, and if he's excited, it has to be something pretty amazing. And that is a good signal to look for when you're looking for projects that you want to investigate or buy into. Just curate your list of experts, and once you've got that, you save yourself so much time and so much brain power. All you have to do is just open up your phone and look at Twitter and see what Vitalik's thinking today. He might not be excited today, but that's fine. It probably means there's nothing that big on Ethereum on that specific day if Vitalik hasn't gotten out of bed. What do you think, Sam?
I would say, yeah, obviously, other than listening to us, because we are a great source of information as well, definitely listen to more than one expert in the space. And I would just say that definitely find someone who opposes your view. So when
Mm,
I'm feeling overly bullish, I do try and seek out someone who's feeling bearish just to get that opposing view, to challenge my thought processes. And I don't assume I'm always right. So I need to listen to someone who challenges me. And so even though I'm feeling very bullish at the moment, there's still people that I will listen to who are still bearish and people who are still calling for like 15K Bitcoin, just as a sanity check for myself to think, is my thesis correct? Am I feeling this confidence still when I listen to someone who's thinking the other direction? Because there's always going to be someone thinking the opposite of what you think. So don't get in that echo chamber of everybody being the same thing, the same direction. Make sure you're listening to opposing thoughts as well.
mhm. That makes a lot of sense.
All right. So next one there we're talking about is creating good habits, which we kind of touched on there. But what other kind of good habits are you talking about, Will?
This, I think, pretty much summarizes everything we've been talking about so far. Once we've got our strategies and know when to zig and to zag, and we've got our sources and everything, that's fine. That's a strategy on paper. Now, what we need to do is decide how often am I going to execute on my strategy. If my strategy is to rebalance my portfolio, let's say, well, all right, is that once a month? Is that once every 3 months? Well, that becomes my 3 month habit. If another strategy is to curate my sources and follow them, how often do I do that? Is that every morning? Is that every Sunday? Whatever it is, I do need to create a habit, because a habit almost becomes eventually becomes something you actually do by instinct. It's muscle memory. And that's when you realize suddenly, by doing this on a consistent basis, you actually become a decent investor. By looking at, let's say, one project a day, that's quite a bit of dedication. But over time, you actually start to build up your bullshit detector, and you can look at a project and tell in a couple of seconds, I'm not even going to read any further. This is just like the other three I read last week. And you can also tell, wow, I've never seen anything like this before. Let me dive in a little bit more. And that is the power of having habits, or rather converting your strategy into a set of habits that you just do either daily or weekly, depending on your time and space. But once you've got your habits, now you're on a guaranteed path almost to, well, to somewhere, depending on how good your strategy is. But then you can still iterate and make sure that you're heading in a good direction. What are your thoughts on habits, Simon?
Yeah, obviously, habits are a huge influence on success in life in general. It's just not to do with investing either. So these habits are
Mm,
probably good for applying to every aspect of your life. You know, remove more of the bad habits and replace them with good habits, and you're going to do well, basically. You're going to be
mm,
happier.
mm.
You're going to have all the better things in life that you actually want when you can change bad habits for good habits. So this is not just investing advice. This is just general life advice. But we're not perfect. So don't, beat yourself up if you've
Yeah,
got some bad habits in life. Everyone needs some bad habits because that's, I guess, a bit of the spice of life.
that's it. But I think they do protect us from um, sort of almost getting carried away. I do get tempted to get carried away. Let's say when Pepe came out, I thought to myself, holy moly, there's some token I've never heard about. But I think one thing that kind of saved me was, yeah, the habits. I saw it, but then the strategy told me, like, well, you just spotted Pepe, but look at the market cap and look where it is. It's a little bit too late. I wish I'd got into Pepe early, but if I'd gotten it at the time that I spotted it, I'd have lost my money. So, I mean, there you go. It's the habits and the strategies, they really do help.
Well, that gets us into our next topic there, which is get in early and DCA, or dollar cost average. So why is that important, do you
Mm.
think?
Late money is usually risky, and it might be at the end of the game where everybody is selling. And it's very tempting to find a project that's, oh, it's gone 100x, it'll probably go 100x more. It's tempted to get into these projects, but usually if you hear about them by the time they've done 100x, it's probably really late. It's probably really late, and that's when it starts to get risky. What you want to do is uh, follow the tide of the market and get into things when they're dirt cheap and no one's even interested in them. That's in the bear market, and that's where you start to actually dollar cost average when the prices are going down. You've done your research and this looks like an interesting project. You feel like you're probably at the bottom of a market, and you might honestly be wrong by 6 months, maybe even longer. But then the good thing with dollar cost averaging is you're putting money into projects that you know are good. It hurts because it's a bear market and your prices are still going down, but then you're accumulating more and more and more. And at some point, the bull does kick in, and this is almost guaranteed with Bitcoin. You could DCA with Bitcoin all the way down and then just watch it go up. At some point, the market is going to start going up, and that's why you fasten your seatbelts. You've done your homework. The rocket is ready, and you're ready to start going up and let it take you where it's going to take you.
I kind of have a slightly differing view to that in general, in that dollar cost averaging and getting in early are kind of conflicting with each other to a degree, because getting in early is obviously important for low cap, high risk plays because they can move really quickly. And if you dollar cost average on a high risk project over several months, then you could have seen the whole movement. So when we're talking about getting in early on low market cap coins, I think that is, for a very small percentage of your portfolio, I would tend to not dollar cost average into those plays, because I'm talking about 1% of my portfolio going into these kind of plays. I don't really dollar cost average that in. I dollar cost average into the high conviction plays that are already well established, that I have a much longer time horizon on, that I'm willing to hold for years, not potentially the months of the volatility of these smaller items. So dollar cost average, I think, is great for high conviction, low risk plays where you don't really care about the small movements of the market because it doesn't move a huge amount. So keep that in mind. There's a big difference between investing in low cap, high risk versus high market cap, lower risk coins.
How would you get into low market cap, high risk, uh, let's say during a bear? Would you dollar cost average into that, or would you um, put in a little bit more and then hold on and
There's two
wait it
things to
out to
remember.
the bull
There's
market?
two things to remember when you're getting into high risk, low cap coins. Is that there's not a lot of liquidity. So it's not like you could be a huge whale. You can't go dump $100,000 into these things, man, because this would
Mhm.
be stupid for one. But there's not liquidity there, so you can only put in small
Mhm.
amounts. You may only be able to buy $500 worth of the token before price
Yeah.
goes absolutely insane. We used Pepe as an
Mhm.
example before. So if you started dollar cost averaging into Pepe, well, that thing went from nothing to 1,000xing in the space of a month. So dollar cost averaging there would have been completely pointless. You would have been trying to find that hype, find it at that lower stage, and putting that $500 into it, because that's pretty much all you could put into it. So remember, when someone sits there and goes, "Oh, you could have made a 4,000x on this coin," well, you probably could
Mhm.
have if you'd bought it right at the start, but there would have been only enough ability to buy maybe $100 worth of it at that point in time, because
Mhm.
there was no one selling it at that point in time, so there was no price on it. So you got to keep that in mind. These low cap coins, you can't put large amounts in anyway because there's just no one there selling it. And dollar cost averaging in doesn't work so well when something is going to move and move fast. So keep that in mind. And this is super high risk plays, very small percentage of a portfolio that you would use in this.
I have to agree with you there, Simon. And I think the word you put there was conviction. And to be honest with you, if it's something like Pepe, it's really interesting. I love Pepe, but I don't have a lot of conviction. I wouldn't put a huge part of my portfolio in there. And to completely agree, dollar, yeah, if it's Pepe and I'm gonna get in, let's say it's $500, just throw it in there, and also get ready to eject. really quickly because these volumes drop really quickly. We saw that with Pepe. The volumes went up really fast when it was on the news. Again, it was the news selling the opposite volume for them to get rid of the tokens, and the volume dried up and Pepe went down. It's still there, but the time to make a lot of money from Pepe is probably over, maybe until the bull.
Maybe, but I might talk about Pepe when we get a bit lower, when we talk about specifically comparing risk to reward. We've talked about Pepe a bit there, so I'll use that as my example when we talk about that later. But I guess the next kind of process that we're going through here is super important for crypto investing in general, is using a hardware wallet.
Oh man. So it's almost never stated enough. And a lot of people make mistakes by, especially when they're doing crypto, just download this wallet. It looks really good on the Chrome store. I'll store it on my computer. That's really risky. And it's really hard to be certain that your computer is secure. It doesn't matter how good you are. If you've ever connected your computer to the internet or ever stuck a hardware thing onto your computer, you never know. And in terms of crypto, having a bit of paranoia is actually healthy. You've got to imagine that there's people hitting the walls after your money because they are there. um, and so we've got to be careful. And the laptop is the absolute worst place you can put your tokens in. And better than a laptop is exchanges. It's better to put your money in an exchange than a laptop because they have bulletproof security. Now, the risks that you face there is liquidation or the exchange going down. But with somebody like Binance, chances are that it's probably safe. But for sure, I trust Binance before I trusted my laptop. What else do we need to think about, Simon? So, exchanges over laptops.
Well, I had to change my view on this because I think crypto needs to evolve. Because yes, hardware wallets are important, especially if you are in this space and investing a significant amount of money. But not everybody wants to do that. Not everyone's going to be capable of doing that. So crypto has to change, and there does need to be a way where people don't have to take full self custody. So people
Mhm.
getting into the space, I did used to teach them and say, if you've only got a small amount and you don't have the time, leaving them on one of the big exchanges is probably safer, because if you're not willing to take that step up to understand self custody, understand your private keys and how to keep them safe, then you're likely to lose it. Like if you're the person who's going to write your seed phrases down a piece of paper and put that piece of paper in the drawer, maybe self custody isn't for you. You're not willing to take that level. But then FTX crashed on us. And so that really changed my perspective.
Yeah.
It's like, okay, well, we need to learn more about this, but I also think the crypto industry needs to step up and kind of find a better way. And remember, Ledger had its recover system that came around, and it
Mm.
got obviously
Mm.
smacked down by crypto people in the space. I think
Yeah.
we do need a product like that in the market for people who don't want to go that full level of self custody.
Mm.
So
Mm.
I guess that's kind of going off topic a little bit there, but
It makes a lot of sense. Yeah.
exchanges is where everyone starts, and
Mm.
they used to be safe, and they're reasonably safe. I guess,
Mm.
use the Lindy effect. The exchanges that have been around the longest are probably safer. I guess at the end of the day, FTX hadn't been around that long compared to other exchanges out there, but it obviously got huge amounts of volume because it made a great user experience. But maybe that's how you can judge it as well. If you're going to just leave money in exchange, stick with the ones who have been around for closer to a decade rather than the ones that are just coming out in the next cycle. But if you've got a large amount of money, yeah, you need to figure out self custody.
Yep. A good one I've actually heard from Antonopoulos is that if everything else is really hard, consider using a phone, and don't make this your everyday phone that you carry with you everywhere. That's just asking for trouble. But if you can't afford a hardware wallet or exchanges are tricky, you can find some open source software that's probably been audited by a bunch of other developers, and just put that on your phone and use that as a form of a hardware wallet. It's better than nothing. It's safer. It's harder to put viruses on phones, so it's safer than a laptop, and you do have a form of self custody. But it's something that we need to be aware of. I mean, if I had a lot of money, I definitely would be careful about where I kept it.
Yeah, I think a really good rule of thumb is, how well do you sleep at night with X amount of dollars stuffed underneath your mattress? And so that's what you've
Mm,
got to start thinking of is if you're leaving it on an exchange, that's the same as kind of leaving it outside on your doorstep for someone to just come along and take
mm,
per se. So you've got to have that process in mind. And that also comes with how do you save and store your private keys? Where are they stored? Are
mm.
they stored under your mattress in your house? How safe do you feel about that? If it's $1,000, you're probably perfectly fine with it sitting under your mattress at home. If it's $100,000, I wouldn't be comfortable with that sitting under my mattress. So that's the kind of thought process that I think people should have.
Yeah, yeah.
All right, so let's move on to
Uh,
some specific strategies. And I'm interested to hear your opinion on this because I have a strong opinion on this one. And this will help the viewers, I think, understand some more specific thought processes, especially for what I go through, is HODL.
mm.
What do you think, Bill? Is HODL a good strategy?
Ooh, that's a bit contentious. I want to say it's good and bad, and I think it depends on where you are in your crypto journey. In that, if you just started out with crypto and you don't want to get too deep into strategies or anything, I think the only two rules to follow would be get in during the bear and hodl. And then you could start to figure out the other rules later. But once you hodl, it's a guarantee that at some point your portfolio is going to go up maybe 10, 20x, maybe even 100x. But it's also a guarantee that it's going to drop really hard. But if you did get in during the bear, you'll probably be fine. And you might end up having made maybe even 20%, maybe double more than you started. But at that point, that's when you realize, I should have sold, but there's a trick to selling. So I think it's a good starting strategy, but I think could evolve to something better. How about you,
I think it's a
Simon?
terrible strategy. I think HODL is a terrible strategy. Unless you are speaking about Bitcoin and Ethereum
Mm,
for a
mm,
long time horizon. If you're talking to, I speak to people
mm,
who are sitting there going, I'm buying this for, I'm going to hold it for 10 years. If you're thinking about
mm,
buying anything other
mm,
than Bitcoin and Ethereum and holding it for 10 years, I think you're a bit crazy because there's absolutely no guarantee that those are going to go up. So hodling is only good for Bitcoin and Ethereum, and only if you have that long time horizon. Hodling anything
mm.
else is just dangerous because most of them will probably still fail. So we're talking about market cycles going up and down. Yes, you could 10x your money, but there's no point 10xing your money that then loses 95% of its value kind of thing. So
Mm, mm.
you need a different strategy for altcoins. Bitcoin and Ethereum,
Yeah.
different. They've reached a different class. Any other altcoins, HODL's a bad strategy.
Mm. I think the okay, I agree with you. And maybe I should rephrase in that get in, but if you really want to keep holding crypto, I guess switch to Bitcoin or Ethereum and then hodl those, or maybe just the top 10%. But let's be honest, that top 10% has changed a lot. There's tokens that used to be in that top 10, and we've never heard about them in a long time. So only Bitcoin and Ethereum have survived. I think the thing that tempts a lot of people is that they look at this token and they go, oh my God, it might be the top 10 one day, so I'd better hodl. But maybe one thing to consider is that even Bitcoin, it's at a super high place and it used to be pennies and it did go up and down. And they do tell you about the Bitcoin pizza. But then, even way back then, it still went through its tides, its peaks, and its troughs. And you still knew that, yeah, I'm in a Bitcoin bull, I'm in a Bitcoin bear. Somebody who kind of dollar cost average in with Bitcoin, I suspect would have done a little better than somebody who got in and just hodled. But I guess the time in the market still worked out for everyone who got into Bitcoin, right?
Absolutely, it did. But assuming that you've found the next Bitcoin is presumptuous. But
Mm,
you're right, there
mm,
is a time to hodl some items and there is time to build conviction in others. But I still think that if you are looking at altcoin, you should be definitely considering when you are selling, not hodling it forever because it's highly likely to lose its value very quickly in a bear. So keep that in
mm,
mind.
mm,
Moving
mm,
on, and this is a big one which people don't get a lot of as far as when build strategies, because we're talking about how do you figure out when you're going to sell something. And so market cap is your best guide for this, in my opinion. So the market cap is the price of the unit times by the total supply of that token or coin. So when you're talking about
mm,
the Bitcoin one, the market cap is the 21 million, or it's not, it's like the 19 million it's currently available, times by the price gives you the market cap. And that's like what, 500 billion right now, give or take. So great examples is always what always comes up is like Doge and Pepe, I guess, at the moment as well. When people say, Doge is going to go to $100, and when you actually times $100 times the circulating supply of Dogecoin, it makes it more valuable than Apple, so
Mm,
or Google or probably sometimes a bunch of them combined. So that's ridiculous. There's just absolutely no way it will ever do that. So
mm,
when I applied this thought process to altcoins, I expand out to where I can see it going as far as a market cap. I forget about the price itself. I just go, what kind of market cap do I see this being? Is it a layer one? How competitive a layer one could it be? Could it be as competitive as Ethereum is now? Not as Ethereum in a bull market, as Ethereum is now. So that kind of process. So if it's a specific project and people are giving projections of the market cap getting to something like 200 billion, 300 billion that Ethereum is now, I think there's no chance. There's very
mm,
hard for an individual project to get as valuable as Ethereum is now. So that really
mm,
helps you figure out the price that you're going to target. What's the comparables? What other projects are out there who do similar thing? What market caps have they gotten to? What market caps have they gotten to? And find your range in there where you feel comfortable saying, yes, I believe this alternate layer one, say Solana. Yes, I believe Solana could be as valuable as Ethereum is right now in the next bull market. So therefore, how high does the price have to go to get to that $200 billion market cap? And it's a really good way of keeping a sanity check on it.
mm. Yeah, that makes a lot of sense to me. And maybe another thing to consider is that when we're comparing Solana or a new layer one to, let's say, Ethereum, we've got to think that, well, Ethereum's been a while and there's so many projects on top of it, and there's a lot of layer twos on top of it, so much economic activity going on. And also gas fees being paid. And so when I see this new project that's coming out, uh, it's so important to think about where is it right now? Is it $10 million? That's a sweet spot for me because I see a lot of room for growth. But if it's up there in the hundreds of millions already, I think it might be overpriced, especially if there is no economic activity going onto it. I usually don't want to touch those coins. I feel like that's a little bit late. But to agree with you, market cap is such a good way of looking at these things.
Yeah, and that's how we laughed about WorldCoin with its valuation, a fully diluted valuation of 21 billion. It was a top 10 coin, more valuable than Solana and Matic combined. And you're like, there's no way that it deserves to be that. There's no way that valuation is fair. That price can only go down from there. So it's easy to use it to spot something like that. It's harder to project out where something might become, and that's where conviction and understanding the project comes to play. But definitely use market cap as a guide. Uh, Moving on, this is one that I use as a definite strategy. Is to sleep on it. Like that, there is no time pressure per se. People think that you've got to act fast, and if you're feeling a sense of urgency to buy something, to do something, sleep on it.
Mm,
Don't act on that thought process now. That's letting your emotions take control of you. So you might go, oh, but if I don't act now, I'm going to miss this 5x. You're probably not. Prices do move fast, but they don't usually move that much in the space of 24 hours. And if you've missed a big candle in that space, well,
mm,
maybe that's okay too, because you're going to miss the ones that go the other way as well sometimes. So don't feel time pressure. Don't feel you have to act now. Sleep on it before you go and buy something. So that's pretty much what I do all the time. When I've found a play that I want to make, I will always figure out my conviction, figure out my sell targets, then sleep on it. Wake up in the morning and have a refreshed look at it. Do I still feel the same way about that one? What do you reckon about that one, Will?
Oh my God. I've got to agree with you on this one. It sounds really boring, but it would have saved me so much money, especially when I was really new in crypto. Sometimes I'd be sitting at work and I'd see this new news thing. Vitalik just tweeted this, and I would run home, jump on my computer, and buy whatever token it was that had Vitalik's face on the website. I did end up losing a little bit of money here and there. Whereas I do remember sleeping on Bitcoin and Ethereum way back, and I do remember making my gains because I actually did my research and I thought to myself, wow, this is a really interesting token. And I got in, and guess what? Ethereum has done for me so much better than anything that I've chased over the years. I don't do it as much anymore. In fact, I don't think I do that anymore. But it is so tempting. And usually when you get that, you got to hurry up and buy. To me, that's usually a signal that the early money already went in. They knew about this thing probably months ago. And now here's the news telling me to buy because somebody wants to sell. And yeah, sleep on it is such great advice.
I think we've all made these silly mistakes as well because I actually have. It's kind of burnt in my memory. At one point, I was actually at my daughter's swimming lesson. So I was sitting on the side watching her doing a swimming lesson, and I was on my phone feeling this pressure to go and buy. I can't even remember what the crypto was. Might have been EOS, and I felt this
Yep.
huge pressure that I had to do it now while I'm out at that. And so it was really dumb. It was really stupid. But I guess it's a lesson learnt. And one thing I also tell
Yep.
people is that I know there's a plethora, it's a tough word,
Mhm.
of
Mm.
apps out there that allow you to buy things. And maybe I'm showing my age too much because I'm sure, people in their early 20s are going to say, oh, I only use my phone for everything. But when you're investing, I sit there and say that do it in a calm, comfortable space. Do it at your laptop at home. Don't feel like you got to do it on your phone when you're out, even when you sit on the
Mhm.
couch per se. You're investing here. This doesn't need to have the urgency, and that's what a phone kind of builds to you. It builds this element of urgency because I can do it wherever I want to do it wherever. I don't like that. If you're going to buy crypto, do it in a calm, collective manner on your laptop somewhere. Don't do it on the go.
Mm.
I don't know. That's just my thoughts on that.
Slow and steady does win the race in terms of crypto. I've never seen like a super fast person coming out with millions of dollars in crypto. It's always that guy or girl who did their research super early, got into a project, had their conviction, dollar costed average in, dollar costed average out. They end up on
Abs-
top.
Absolutely. And so next, we're talking here about percentage of portfolio and what coins. So this is a really good thing that you need to set for yourself early on. And so, from my perspective here, is that there's a huge temptation to put a large percentage into the smaller cap coins because there's obviously a much bigger reward potential. You've got to find out where you fit on that risk reward, profile because maybe Ethereum just doing a 4 or 5x for you doesn't reach the goals that you want. So you're willing to take on more risk. That's okay. Come up with that portfolio percentage. But if you're going into really low market caps, things under 100 million, things under $50 million market cap, really consider how much your portfolio can do that. For me personally, it's only like a
Mm,
1% of my invested money goes into those small cap coins. And I keep it usually to 3 to maybe 5 of these small
mm,
cap coins that I will actually make this play in. The rest of my money, a huge amount of it, is pretty much going into Ethereum and the high market cap coins. So, yeah, majority of my
mm.
money is there. But you've got to find out where you fit on that and write this one down. This is a good part of your strategy because if you try and put too much portfolio into those high risk ones, you're probably going to get burnt.
Oh yeah. Oh yeah. And maybe rebalancing is kind of tied into this in that if let's say I'm more high risk and I decide to put 80% on Ethereum and Bitcoin and 20% on pretty much anything I choose, I could say to myself, right, every month I'm going to go back to my portfolio and I'm going to make sure that these percentages are the same. And that means that if my low cap does shoot huge in 1 month, I'll come back and say, oh my God, it's 30% of my portfolio now. I'll convert some of it back to Ethereum. And that way I'm holding something that's more stable and secure, taking my profits. And I can keep doing this throughout the whole bull market. And so that even if the bear just hits me all of a sudden, at least I won't be left holding a bunch of these, I'm sorry to say this, shit coins. At least most of my portfolio will be on something that's stable that I know, yes, it's a bear, it's going to crash. But yeah, Ethereum will probably be around next bull as well. But these new tokens, we don't know yet. We don't know yet.
Yeah, I agree with that. But my thought process isn't around just moving it, rebalancing like that. My thought process is around if I've bought a low cap coin, high risk, and it has done well, then I sit there and go, well, would I buy it now? And how much further do I think it can go? Because sometimes, and I've had this recently with one of my high risk plays, is that it did really well, but it got to a point where I thought it could only maybe do another 5x to where I thought where its
Mm,
market cap should possibly be in the long term. And so the
mm,
thought process there was, would I buy it now for that 5x? Well, the answer is no. I'd rather put that money into Ethereum because I'm pretty sure that's a much lower risk, but still likely to 5x for me. And so I exited my
mm,
position because I thought the further up it could go was not worth the risk of holding. I could take my profits, move that back into Ethereum, where the 5x is a little bit lower risk. So that's my version of rebalancing. It's not keeping a percentage of my portfolio in the different amounts. It's looking at a token and how well it's performed and how much it will perform from here. Because you've always got to think that if you're not going to buy this XYZ token at this price, then you shouldn't also be holding it, is kind of my thought process, because you wouldn't buy then, so why are you holding it? It's time to exit that position. And again, this is for small cap coins. This is for small amounts of money. This is not thinking of a longer term portfolio. So keep that in mind.
Oh yeah, totally. I would rather hold Ethereum if I'm expecting a 5x than some new thing. To hold that other thing, it better be going up 30x, and then I might think about letting go of Ethereum and holding this other new token.
Absolutely. And so the last one that I want to talk about here, which is I think really good to give people some concept about this myth of, timing the tops and timing the bottoms, buying low and selling high, because we're not that good. We're not that good at selling the tops or buying the lows. And when people show you, from the bottom to the top, it did 4,000%, so 40x, but realistically, you're not going to get that. You're not going to buy the bottom. You're not going to sell the top. If you think you are, you're crazy. So I like to do this analysis, and I think it's a really good one for people to see, is that what if you just bought 15% from the top? I mean, other way around. What if you sold at 15% from the top and bought 15% from the bottom? Because this gives you a realistic target of where you might get, and it gives you an understanding of how hard it actually is. So if we use Bitcoin, for example, so 69,000 was the top in November 2021. So take 15% from that. So 15% from that is $58,000. So you've missed the top by 15%, which sounds like a lot, 58,000 but 69,000. How long was Bitcoin actually in that range? It was only in that range for 4 weeks. So for you to be buying within 15 or selling within 15% of the top, you only had 4 weeks to know it. And so how good are you at doing that? And on the reverse side of that, the bottom of it, how long was it at the bottom? So it hit the bottom of 15K, but it was there longer. It spent about 8 weeks, 15% from the bottom. So $17,000. It spent about 8 weeks there. So if you bought the bottom, you had, like a day or like an hour. There's only one person ever buys the real bottom, but you had 8 weeks there to actually accumulate in that space. So that's Bitcoin. There's only 4 weeks to sell at the top, 8 weeks to buy at the bottom. You're not likely to do that. And that's within 10%. Just keep that in mind. That's within 10%, 15% of those tops and bottoms. So it's really hard. But Bitcoin is less volatile than the others. So I did the same look at Solana. So Solana, 15% from its top, was only there for 2 weeks within 15% of its top. And its low, 15% from its low that it had in November 22, sorry. One day it was only down there. Then it jumped back up over 15%. So you didn't even get close to buying the bottom of Solana. So keep these things in mind. You're not going to buy the bottom. You're not going to buy the top. When people sit there and extrapolate out how much you could have made if you bought from the bottom, it's rubbish, because no one does that. What are your thoughts on that, Wilma?
I've got to agree with you. I've always known that it's hard, but I've never actually looked at the prices and realized that it's that hard. I have to confess, though, Simon, that I think everybody who's new to trading thinks that they can nail the bottom and nail the top. I've got to say, I've been there. I tried technical analysis for a while, looking at the charts, thinking that I could do it. It's not that hard. There's this guy on the TV who said, "This is how you do it." And I don't know. I think it's impossible. It's impossible. I think everyone's super welcome to try. But if it was that easy, we'd all be super billionaires by now. We'd know when the tops and the bottoms are coming. So, but then, what's the solution here? Then we can't pinpoint the tops and the bottoms. So, what's someone to do?
Well, I think the solution is, in this case, is to accept that you're not going to buy the bottom and sell the top, and factor that in. If you're projecting out the top, then maybe your sell price should be lower than as high as you think it could go. So if you think Bitcoin's going to go to $100,000, then maybe you want to try and sell your Bitcoin at $85,000 in case you miss that. So just keep it in mind, I think, is the answer, is that you're not going to sell the top. So Know that, be okay with that, and know if you sell within 15% of the top, you've done extraordinarily well. And that is probably as good as you're going to do. That would be incredible if you did that. So be okay with that. Be okay with selling 15% from the top because you've done incredibly well. Most people in the space won't do that.
I think selling is probably really hard for a lot of people. Once they see that token go 5x and then it's 10x and then it's even higher the next week, it's so tempting to let go of it. Bitcoin is at 30,000 now. Let's say it gets to 80,000. There's somebody out there who'll be thinking, "Oh, this thing might hit 100. I'm going to sell at 100." But there's no guarantee that Bitcoin will hit 100, and it's so difficult. And for me, I think what I've realized over the years is that once I feel like Bitcoin might be running out of steam, I just start exiting and maybe even start following up my positions with stop losses. It might hit my stop loss. That's fine. That's fine. All I know is that as long as I can dollar cost average my way out, I'm just going to be happy, wait for that market to crash, and buy back in. I just wish I'd started this years ago. Yeah.
Everyone wishes they bought Bitcoin earlier. So that's nothing new. So if you have made it this far, thank you very much, guys. I hope you've gotten some value out of this. I think there was some real gems in there, and I certainly learned a few things from Will as well. So please leave some comments, leave some likes, do all the things that help other people get out there, because this is the stuff we love doing. We love trying to help other people. So if you enjoyed that, please let us know. Will, any final thoughts, mate?
Just important to have a strategy. I learned a lot from you as well today, Simon, and yeah, I'm looking forward to the comments that we get. And if you guys want to get more specific into our personal strategies, just let us know. We're both engineers. We've got quite a bit of experience under our belts, and we both have different skill sets, I guess, and I guess they complement each other when it comes into topics like this. But yeah, remember to give us a like and a subscribe, and thank you, Simon, and I guess until next time. That was a long one.